Today, we're doing a complete breakdown of ASC 350. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 350, companies could mask losses by overstating intangible asset values. In 2002, Goodwill impairments alone reached over $50 billion. This standard brought clarity, ensuring assets reflect true economic value. By the end of this section, you'll grasp how ASC 350 redefined asset valuation and its significance for financial transparency. ASC 350 came into play to fix the rampant overvaluation of intangibles like goodwill. Companies could no longer slowly write off goodwill that might not even hold value. Instead, ASC 350 requires annual impairment testing, which identifies actual losses in value. This shift ensures financial statements present a more accurate picture, fostering transparency for investors and stakeholders. Imagine a tech firm overstating its brand worth by billions. ASC 350 ensures this can't happen unchecked. ASC 350 is a must-follow for any entity adhering to US generally accepted accounting principles. Effective from 2001, it demands rigorous annual goodwill impairment testing. This requirement ensures that a company's intangible assets, particularly goodwill, are accurately reflected in their financial statements. Annual testing helps detect impairment early, preventing prolonged overstatements. By enforcing these rules, ASC 350 safeguards investors and stakeholders from distorted financial information, ensuring decisions are based on reality, not inflated figures. The goodwill impairment model is a core part of ASC 350. Instead of amortizing goodwill over time, it requires annual testing to spot real drops in value. Companies compare fair value with book value, and if the former is lower, they record an impairment loss. This model keeps financial statements honest, crucial for any analyst assessing a company's health. For interviews, understanding this model signals you're ready to handle nuanced asset valuations, a vital skill in finance. Candidates often miss that intangible assets with finite lives aren't covered by ASC 350. Classic interview bait. Getting scope right is crucial because misclassification can lead to incorrect financial reporting. Knowing what's inside ASC 350 could mean the difference between strategic insight and costly oversight. ASC 350 focuses on goodwill and indefinite-lived intangible assets. Goodwill arises from business combinations and requires impairment testing, ensuring it reflects fair value. Trademarks, often indefinite-lived, also fall under this standard. Companies must test these assets annually to avoid misstatements in financial reports. For instance, a $5 million goodwill from acquiring a competitor needs scrutiny under ASC 350. ASC 350 doesn't cover finite-lived intangible assets, which are amortized under ASC 360. R&D costs are expensed under ASC 730, not capitalized under ASC 350. This exclusion means companies must account for leasehold improvements differently. Interview questions may probe these exclusions, especially when discussing technology investments like internal use software, which isn't under ASC 350. Goodwill represents the premium paid over the fair value of net assets during an acquisition. For instance, if Company A acquires Company B for $10 million, but B's net assets are only $8 million, the $2 million difference is goodwill. This asset requires regular impairment testing to ensure it remains accurately valued, as per ASC 350. Impairment under ASC 350 is a permanent reduction in an asset's value, crucial for goodwill and intangible assets. If a company faces a downturn, its $3 million goodwill might be impaired, reflecting decreased future cash flows. This impairment impacts profits, requiring careful financial statement adjustments to maintain accuracy. Consider these edge cases. Acquiring a business without goodwill means ASC 350 isn't applicable. Internal use technology assets, even if acquired, are excluded. Developing a new product line involves R&D costs, which aren't ASC 350's domain. However, an acquired trademark with an indefinite life requires regular impairment checks under this standard, emphasizing its scope. Picture a business acquiring another for $10 million, only to find its expected gains falter. ASC 350's Goodwill Impairment model tackles this by systematically assessing and recording goodwill impairments. It's crucial to ensure financial statements remain truthful and reflective of a company's true financial position. This model is a roadmap for recognizing when goodwill initially recorded during acquisitions loses its value. Using Meridian Corporation's $10 million SaaS contract with Acme Incorporated, we'll see how each step ensures accurate financial reporting. From identifying units to recognizing impairments, this process upholds transparency and precision in financial statements. Meridian Corporation must first identify its reporting units for the $10 million SaaS contract with Acme Incorporated. This means recognizing segments like software license and services, where cash flows are distinct. Confusing these with operating segments is common but misleading. The correct identification sets the foundation for accurate impairment testing, crucial for the process. With reporting units identified, Meridian Corporation assesses the carrying amount for its $10 million SaaS contract. This involves summing assets and liabilities from the identified units. Overestimation or omission can dramatically affect outcomes. ASC mandates precise inclusion of goodwill, assets, and liabilities, ensuring an accurate foundation for the next evaluation. Meridian Corporation now estimates the fair value of its units from the $10 million SaaS contract. This involves market-based evaluations, ensuring these values are realistic and aligned with industry standards. Failing to use market assumptions can lead to inaccuracies. ASC insists on reflecting market conditions for credible assessments, guiding the next comparison. Meridian Corporation compares carrying amounts with fair values for its SaaS contracts units. If the carrying amount exceeds the fair value, it signals potential impairment. Ignoring market shifts can skew results. ASC emphasizes a fair, unbiased comparison, ensuring the carrying amount truly reflects the unit's market value. Setting up the final step. Finally, Meridian Corporation recognizes an impairment loss if its carrying amount surpasses fair value, writing down goodwill for the $10 million SaaS contract. Missteps in adjusting goodwill distort financials. ASC ensures that impairment losses appear in income statements, accurately reflecting the company's updated financial health and ensuring transparency in reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 350 guides on selecting methods and mandates disclosures that reveal the true economic value. Let's explore how choices made here ripple through financial reporting. Recognizing intangible assets at cost is crucial, especially for acquired assets. The acquisition date sets the stage for how these intangibles are handled. Understanding when future economic benefits are probable influences whether an asset appears on the balance sheet, impacting value perception and investment decisions. Subsequent measurement under ASC 350 distinguishes between amortizable and indefinite-lived intangibles. For indefinite-lived, annual impairment testing is crucial. Unlike amortizable assets, which follow a systematic expense pattern, changes in useful life or market conditions may trigger remeasurement, impacting both current and future financial statements. How intangible assets appear on financial statements under ASC 350 is vital. They are listed as non-current assets, with detailed notes explaining their nature and useful life. Impairment losses, which directly hit the profit and loss, can change investor perspectives on earnings quality. Proper classification aligns financial reporting with business operations, revealing true economic substance. ASC 350 mandates disclosures that are critical for transparency. The gross carrying amount and accumulated amortization reveal how intangibles are utilized. Disclosing useful lives and methods provides insight into management's approach. Detailed impairment loss information ensures stakeholders understand the assumptions behind asset valuation. Tracking changes in carrying amounts over time enhances the ability to evaluate management's strategic decisions. Consider a CFO managing a $10 million intangible asset. Market shifts trigger an impairment test, resulting in a $2 million write-down. This decision directly affects earnings, requiring transparent communication with investors about profitability expectations. By aligning book value with economic realities, the CFO demonstrates responsible governance, ensuring asset values reflect true future benefits. Such proactive management builds stakeholder confidence, even when short-term earnings take a hit. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Discover how ASC 350 drives the financial reporting for such intangible assets, ensuring clarity and compliance across the board. The recognition of the right-of-use asset and lease liability is pivotal under ASC 350. For Meridian Corporation, this means acknowledging the economic benefit of the warehouse while recording the obligation. This impacts both the assets and liabilities, ensuring the lease is transparent on the balance sheet. Amortization under ASC 350 reflects the systematic reduction in value of the right-of-use asset. Meridian Corporation records a $20,000 monthly expense, aligning the cost with the revenue the warehouse helps generate. This method ensures financial statements fairly present asset utility over time. Interest expense on the lease liability represents the cost of financing the asset's use. For Meridian Corporation, this $5,000 monthly charge affects the income statement, highlighting the ongoing financial commitment tied to the lease. It's a critical element of lease accounting under ASC 350. As Meridian Corporation pays the lease, the liability decreases, reflecting the fulfillment of its obligation. The $25,000 cash outflow is balanced by a reduction in the liability, maintaining equilibrium on the balance sheet and ensuring transparency in financial reporting. Reassessing the lease under ASC 350 captures any changes in the lease assumptions. For Meridian Corporation, this $10,000 adjustment reflects evolving financial realities, ensuring that asset and liability figures remain accurate and up to date in the balance sheet. Impairment testing under ASC 350 ensures assets are not overstated. Meridian Corporation's $15,000 adjustment aligns the asset's carrying value with its recoverable amount. This step maintains the accuracy of financial statements, safeguarding against asset overvaluation. Derecognition marks the end of asset utility and obligation. Meridian Corporation's $1,130,000 derecognition aligns with ASC 350, clearing the balance sheet and providing closure to the lease lifecycle. It ensures no residual amounts affect future financial periods. Every Big Four and investment bank interview on ASC 350 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Goodwill represents the excess paid over fair value in acquisitions. It's key in understanding synergies and non-tangible value. ASC 350 requires annual impairment tests to ensure goodwill is not overstated. A common mistake is confusing goodwill with other intangible assets. Remember, goodwill isn't amortized, only tested for impairment. ASC 350 treats goodwill as a separate intangible asset, not subject to amortization, but tested annually for impairment. Other intangibles, like trademarks, might be amortized over useful lives. The trap is treating goodwill like a finite life asset. Key takeaway: goodwill impairment, not amortization, affects financials significantly. Goodwill must be tested annually, and when a triggering event indicates possible impairment. ASC 350 gives flexibility, allowing companies to choose the testing date. Mistaking this for a quarterly requirement is common. Remember, annual and event-driven testing ensures goodwill reflects real economic conditions. A goodwill impairment reduces the carrying amount on the balance sheet and hits the income statement as a loss. Under ASC 350, impairment tests compare the reporting unit's fair value to its carrying value. A mistake is omitting this from income, skewing profit figures. Correct reporting ensures transparency. ASC 350 mandates annual impairment testing, whereas International Financial Reporting Standards allows indefinite life assets to bypass it unless indicators arise. Amortization isn't used under either, but International Financial Reporting Standards' more relaxed approach can lead to different impairment recognition. Confusing the two standards can result in reporting errors. Understand these nuances for accurate financial reporting. Indian accounting standard aligns closely with International Financial Reporting Standards, contrasting ASC 350, which emphasizes annual impairment. Indian accounting standard also requires impairment, but offers more leeway on testing frequency. Common trap: assuming uniform global standards. Key: ASC 350's rigorous annual test guards against overstatement, crucial in valuations and M&A assessments. The impairment loss is $2 million, calculated by subtracting the fair value of $8 million from the carrying amount of $10 million. ASC 350 requires this impairment to be recognized immediately in financial statements. Errors can occur by ignoring this adjustment, leading to inflated asset values. Always verify calculations against actual fair value. ASC 350 does not cover software development costs. These fall under ASC 985 or ASC 730. A frequent error is assuming all intangibles are grouped under ASC 350. This misconception can lead to misclassification and incorrect financial reporting. Make sure to categorize intangibles based on specific guidance. ASC 350 requires detailed disclosures, description of impairment tests, carrying amounts, and events leading to impairment. This transparency helps investors assess asset health. A common pitfall is inadequate disclosure, which can obscure financial health. Ensure disclosures provide a complete picture of any impairment and its impact on financials. Misunderstanding the frequency of goodwill impairment testing is a trap because it leads to financial misstatements. ASC 350 mandates annual tests, and when impairment signs surface, companies often fail to test annually, risking overstated assets. Consistent testing is crucial for accurate financial health representation. Regular testing assures investors. ASC 350 sets the rules for recognizing and testing impairment of goodwill and intangible assets. It applies to both public and private companies, focusing on assets like patents and trademarks. Reporting units are crucial here. They often align with business segments. Goodwill represents future benefits from acquisitions and is tested at these levels. Intangibles with indefinite lives, unlike finite ones, are tested annually without amortization, ensuring accurate financial representation. ASC 350's goodwill impairment model involves annual and event-driven testing. A qualitative Step 0 assesses the need for further testing. Step 1 compares fair value to carrying value. An impairment loss arises if carrying exceeds fair value. This loss is the excess amount. Fair value is vital here, offering a market-based measure. Testing occurs typically at year-end, crucial for maintaining accurate financial records. In interviews, grasping ASC 350 intricacies can set you apart. Understanding that reporting unit misjudgments can skew impairment tests is key. Know the two-step test differences from International Financial Reporting Standards, which uses a single step. Clear disclosures are essential, detailing losses and methods. Recognize triggering events like market or regulatory shifts. Goodwill avoids amortization, unlike finite intangibles. Familiarity with the private company alternative offering a simplified model can be advantageous. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.